Right. Welcome to Coffee with Marcus and Mark, the number one stock market show on Spotify and one of the most popular market updates on YouTube. In this show, we talk about what's happening in the markets and how we are trading them. Today is Wednesday, August 28th. Why everyone is waiting for the markets to close, hint, Nvidia. ANF plunges in spite of an earnings beat. We'll take a look at Abercrombie and Fitch. Buffett dumps more Bank of America stock. Is SMCI in trouble? And should we pay attention to the sausage indicator? Plus, we'll take a look at our open positions and see how Kohl's is reacting to earnings. As you can see, there's a lot to talk about, so let's go ahead and get started. Now, if this is your first time here, my name is Mark Hodge. I'm head coach at Rockwell Trading, and today it is Coffee with Mark, so let's go. Let's get on over here and take a look at a chart of the S&P 500. And right now, the S&P is pulling back, but to be honest, it's been pretty quiet since the beginning of the week. We're trading right where we started the day on Friday of last week. And after Friday's rally to finish the week strong, on Monday pulling back a little bit, Tuesday slightly higher, today pulling back a little bit, but we're really just trading in this range here, right around 5,600. Not a whole lot of movement. And again, it's really because of two things. One, everybody's waiting for Nvidia to report earnings after the bell. And then also we have core PCE at the an hour before the markets open on Friday, an important inflation number there. And this just shows us how quiet trading has been. I mean, this is where we opened up Friday last week. We rallied a little bit, pulled back, made session lows, finished the day strong. On Monday, we opened higher, gapped higher, but then came back down to the same trading range that we saw on Friday. Yesterday, similar situation. We gapped lower, but trading right inside this range today. Really choppy early on. A little bit of a drop here right now, but just choppy and quiet overall as traders wait for Nvidia. So that's what a hurry up and wait chart looks like, and we'll have to see exactly what the markets want to do for the remainder of the day, but more importantly, how the markets react to Nvidia earnings. We can take a look at Nvidia and just see what this looks like. Nvidia chopping around. I mean, looking pretty much just like a chart of the S&P 500. Today down 2.7%, although yesterday up 1.5%. Just kind of moving around here. Actually, here's the NASDAQ. We see the NASDAQ taking a little more heat today, down over 1%, while the S&P is down 0.4%. The Dow hanging in there. Yesterday, able to close at a new record high close. Didn't make a new record intraday high, but 41,250 is a new record for the Dow today. Looks like we're on track. Still a lot of trading left, but at least on track for possible new record in the Dow, while the S&P and NASDAQ a little bit of a dip as we approach Nvidia earnings. And speaking of earnings, let's take a look at ANF, Abercrombie and Fitch, because Abercrombie and Fitch actually reported some really decent earnings, a beat on their earnings per share and a beat on revenue. So they had a real strong first half of the year, but it does appear as though this drop of 17%, maybe a little bit of profit taking, but also tied to some comments by the CEO of Abercrombie saying that there is an increasingly uncertain environment, and this has investors concerned. And I mean, I can understand because, pardon me, I wore an Abercrombie and Fitch shirt just for this occasion, just to honor their earnings. And I bought this shirt in college, so I haven't been shopping at Abercrombie since I was 20. And this only fits because of the quality of the fabric. Most shirts from when I was in college do not fit the same way. Anyway, with that said, Abercrombie gapping down and selling off right now, trading near lows of the day around 138, down 17%, even though earnings were really good. Another company to take a look at. Let's look at well, we can look at Bank of America. Bank of America gapping down today, starting the day negative, but turning things around up 1.25%. Now, the gap down was probably tied to Berkshire Hathaway and the filing that they continue to get rid of Bank of America shares. Now, is this concerning or not? Well, since mid July, Berkshire Hathaway has dumped more than $5 billion of Bank of America stock, and now their stake is just 11.6% in the company. However, is this just the best free trade of all time? Let's take a look at this. This is what I mean here. If we take a look at, well, actually, we need to go back to Bank of America. So if we go to a weekly chart and we look back here, and we need to go back to, there we go, 2011. So here we have the housing crisis, and Bank of America was just crushed, trading around $55 a share at the peak before we get into the housing crisis, and at these lows, getting down to about $2.50 a share. It's unbelievable to think of Bank of America at $2.50 a share. However, in 2011, so 2011, let's just say $10 a share. Warren Buffett comes along and says, you know what? I'm going to buy $5 billion worth of Bank of America stock and warrants, and those warrants give an investor the opportunity to convert them into shares at some point down the road. And back in 2017, Berkshire Hathaway converted those shares. So he was able to pick up approximately $5 billion worth of Bank of America stock. I don't know the exact number, but I mean, if it's even up here at these highs, $14 a share, at these lows, it's closer to $5 a share. And Bank of America has had a pretty decent run there. Also a dividend payer too. So now if he bought $5 billion worth of Bank of America stock back then, and he's unloaded $5 billion, is that number coincidence? Is it a free ride now and nothing but profit on that 11% stake in Bank of America? Possibly. So it might not be this big concern, but instead taking a little profit off the table, still having a decent stake. I mean, 11.6% ownership of Bank of America, that's a pretty decent position. With that said, we have to take another look at Berkshire Hathaway, because Berkshire Hathaway made history for the company, now trading at a market capitalization of $1 trillion for the first time ever. Nice run up here, and Berkshire Hathaway up another 1% today. Now, although there are some other companies in the $1 trillion club, this is the first non-tech company that has achieved this feat and is now in company with other tech stocks. So congratulations, Buffett and Berkshire Hathaway. Nothing like sitting on a pile of cash like Warren Buffett. All right, let's take a look at another company here, SMCI. I forgot to take a look at it in yesterday's Coffee with Marcus and Mark, although I mentioned it at the beginning of the show. And yesterday, SMCI gapped down, actually clawed back a majority of those losses. This initial drop yesterday came after Hindenburg Research, a short selling. I don't know if they're an advisory or they're just an investment firm that publishes reports. Either way, they had said that there are some problems with SMCI and that there is potential accounting manipulation. And it was confirmed that yesterday that they do have a short position in SMCI. Now, today we gapped down and you're seeing a bigger slide here, down 25% now. Now, this comes after Super Microcomputer has announced that its management requires more time to complete, quote, complete its assessment of the design and operating effectiveness of its internal controls over financial reporting. So, is this a big going to snowball into a bigger issue? It's hard to say, but it doesn't look good for SMCI. If they're basically saying, hey, we need more time to figure all of this out. They're not saying that Hindenburg research is right, but it's not looking too good right now. SMCI trading at lows that we haven't seen since the beginning of the year, down a 25% today. Now, I saw an important article today, and it makes me wonder if we need to be worried about sausages and whether the sausage indicator is an important indicator to truly understand economic cycles in the United States of America. Now, according to the Federal Reserve Bank of Dallas, so this is real. This is legit here. Comments from survey respondents with a survey that they did, and the follow through here, what they reported. As the economy weakens, we are seeing modest growth in our category of dinner sausages. This category tends to grow when the economy weakens, as sausage is a good protein substitute for higher priced proteins and can stretch consumer food budgets. Something to worry about. I can't knock sausage, but I will definitely go with a ribeye over a sausage. Although maybe this gauge for consumer activity or what they are trending towards is significant. Now, I saw in a Morning Brew, this is a Morning Brew article, that it's not just sausage. There are some other quirky warning signs for the economy. There's the Big Mac indicator, lipstick index, but also they've reported that declining men's underwear sales could spell economic trouble, as many men apparently opt to wear tattered boxers to save money. I just wait until Christmas and then my wife buys me some. But anyway, who knew that there was the underwear indicator? And then also in the past, the level of grittiness in Marine Corps ads has increased along with economic challenges, since recruitment is easier in tough times. And then also a rise in unclaimed corpses in morgues might indicate a morbidly bad economy in which people seek to avoid a costly funeral. I'm not going to be checking this one, doing some research with morgues to see how the economy is doing, but interesting to see this. And I think this but is important to address, though. A rise in unorthodox indicators could indicate desperation among analysts, since more traditional economic red flags like unemployment upticks, the SAM rule, which everybody freaked out about recently and now isn't talking about, government bond prices, aka inverted yield curves, which again we haven't talked about really in the last couple of years, and even GDP declines have pointed to a recession that hasn't materialized. So I think you need to take it with a pound of sausage. With that said, let's take a look at what's going on with PowerX Optimizer. And here, I actually have ANF as pulled up in our wheel analyzer. And for anybody that thinks that there's an opportunity here in ANF, likes the idea of owning shares of ANF, you don't need to buy shares at 137.77 right now. You could potentially sell the 125 strike that's expiring this Friday. Based on 35 cents a premium, this would give you 34% annualized. The 126 put, this would give you 45 cents or 43% annualized. So there is some decent premium, maybe some short-term support around 132-ish, but it does look like there could be some stronger support a little bit further back, 110, somewhere in this zone here. But if you really like the idea of picking up some shares of Abercrombie and Fitch, it might be a good wheel opportunity. Gives you a little cushion. This is a drop in percent of 9%. So you have 9% wiggle room from where the stock's trading right now to where the strike is. Of course, if it doesn't close below 125 on Friday, then you're not going to own those shares, but you get paid either way. Might be something to consider. Now, WTF trades, no new WTF trades. And to me, this isn't a surprising thing. If we look at the overall market, we're just seeing quiet trading right now. No entries, no exits, no open positions. But maybe if there's a negative reaction tomorrow to Nvidia earnings, there could potentially be some WTF trades this week or maybe Thursday. And looking at open positions, BP, I've sold 34.50 calls on my BP position. Right now, we're trading below 34.50. I'm doing well with this one based on my assignment and the ability to collect premium on those puts and also calls a few times. CSIQ pulling right back to where it ended after this earnings drop. Right now, nothing for me to do with this one, but definitely not what I was hoping to see. It looked like we had a nice little rally. Wondering, are yields spiking today? No, yields really aren't doing anything. Typically, when we see a bigger move, it's because yields are up. So, yeah, that's not what I want to see right now. Nothing to do with CSIQ. Halliburton, another one that I'm in. Right now, nothing to do with Halliburton. Opening lower and selling off a little bit, but now trading above where we started the day, just in this range here. So we'd like to see a little follow through to the upside. This does go ex-dividend next Wednesday, 17 cents. Nice, decent dividend to collect on Halliburton, as it appears I will be a shareholder on record for that day. Coles, Marcus is in this one, and he held through earnings, and there has been a real nice reaction to earnings. Coles up 6%. I think Marcus was assigned to 21.50, but he's been able to collect a lot of premium over the last couple of weeks trading Coles, and Coles did have an earnings beat. They missed on revenue, but investors don't seem to be too concerned with the stock up 6%. Merck, another one on the move today, trading around 118, up 1.25% here. So Merck getting closer to that 120 strike that he originally was assigned at, and a little premium that he's collected on the options that have been sold. This one headed in the right direction, and this was one, it continued to slide, but this was an earnings play back on this day where we had this real nice range for Merck. And I want to say it was trading around 122. Marcus decided to do the 120. There definitely was a little more downside to this one, but the fundamentals were strong. It seemed like it was more of a one-off event rather than something that could snowball into a bigger issue. And right now, Merck looking pretty good. UPS, I'll take the up day, and there's that arrow. So thank you, UPS, for starting to head in the right direction. Just kind of chopping around here. We'll see if UPS can move this week or after core PCE numbers on Friday. And in other news, it's official, and it has been announced that Humpty Dumpty had an okay summer and is looking forward to a great fall. See what I did there? Now, I know that yesterday I forgot a dad joke, so I had to give you a double dose of stupidity today. That was the first attempt. The second one, though, here's an important tip that your shoot, I can't even say it, veterinarian will never tell you. If your dog is running a fever, go to the store and buy some mustard. It's the best thing for a hot dog. And with that said, I'm sorry. But I hope you enjoyed the video. If you did, please give the video a thumbs up. If you're new to the channel, please subscribe. And if you know someone that could benefit from these videos and appreciate these recaps of what's going on in the markets and how we are trading them, more than spending countless hours listening to a bunch of nonsense with talking heads that are out there, then please share our channel. And with that said, I hope you have a great rest of your trading day. We will see you back here tomorrow. Until then, happy trading, everybody.